In Objective 3, we're going to talk about the importance of business transactions, money measure, and separate entities to accounting measurement. So basically in accounting measurement, it requires us to ask 4 basic questions, or I should say, ask and answer 4 basic questions. First thing we're going to ask is what is measured? What is it that we're measuring? What economic event is taking place that we have to measure to ensure that we can communicate about that particular transaction? So what are the transactions? Then we have to determine when should we record that transaction. We need to determine the date of the transaction. So it seems very simple. If I was going to go to the store and buy this particular bottle of Purell, very simple. I walk into the store, it's, Monday afternoon, I go up to the cash register, I pay for it, the transaction has taken place. Much more difficult to try to figure out when the measurements should be made when we're dealing with larger, more complex things. So for instance, we have a large contract, we're building a road, we're building a bridge, we're trying to figure out what are the dates that the measurements should be made so that we can determine what event we're measuring at that particular point in time. Then we have to determine what value we should be placing upon it. In our world, really, we're mostly all going to be dealing with monetary values, dollars and cents. But there are some businesses that do operate doing things such as barter. Okay? So we, in those particular instances, let's say you had a business like Pizzagram. And Pizzagram obviously makes pizza, okay? And then let's say they have somebody that does like the landscaping services for them, okay? Let's say the landscaper said, okay, we'll mow your lawn in exchange for 2 pizzas. Well, what value do you place on that? Okay, how do each of those 2 entities record that type of transaction? So for our purposes, we're going to try to always talk and operate in terms of money, dollars and cents. And then how should what is measured be classified? What parts of that business are affected by that transaction? What are we debiting? What are we crediting? These 4 things relate to something we'll talk about later also in terms of recognition, valuation, and classification. We'll talk about those in a later chapter. So financial accounting uses the money measures to help them gauge the impact of business transactions on the separate business entities. And basically we look at it and we say a business transaction is an objective measurement of the activities that are taking place. And it's an exchange of values, those monetary values, between 2 or more parties. But we also have to think about what we call non-exchange events, because those have to be factored taken into account as well. So non-exchange events would be things that are like, say, losses from, say, floods or theft or wear and tear. So in those particular instances, 2 or more parties may not be exchanging something, but yet the business has to record something. In those types of events, we're going to do adjusting entries, which we talked a little bit about adjusting entries last chapter or last semester. We'll talk about those later in this semester, where we talk about those how those non-exchange events result in us needing to record a transaction in some way, shape, or form. We're going to do that by doing an adjusting entry. And then we have the money measure concept. And that is because money is the only factor that we can use as common to all business transactions.
Mine's the most important.
For some, yes. And the monetary unit obviously depends on the country that you're operating within. And so, to the extent that we're dealing with transactions that take place across different, or between businesses across two or more countries, we're going to have to do translations of the currencies from one currency to another. And then lastly, we also have to make sure we take the concept of separate entities into consideration. So we need to make sure that we keep our transactions distinct between creditors, customers, and owners of a business. Good? All right. In the interest of time, I'm going to pass by these questions. You can write those answers down if you want, okay? BCABA.
Yeah.
Okay.
Oh, I get those answers.
ACB.
ACB.
It's not good enough quick notes.
Squid.
Okay. So in objective 4, we're going to talk about the forms of business organization. Some of you guys may already be familiar with these, and we talked a little bit about, obviously, the first type last semester, the sole proprietorship.
It's like last year.
Yeah,
Yes,
exactly
yes,
like that.
very similar when you did law, right. So a sole proprietorship is an entity that's owned by one individual, and that individual has unlimited liability for that business. So if the business gets sued, the owner is sued. Personally,
Right.
correct. Sole proprietorships are the greatest number of businesses in the United States. They're not the largest in terms of dollars, but they're the greatest number of businesses. And the pros associated with starting your business as a sole proprietorship is that it's easy to start. You make your own decision. It's flexible. There's less regulation. And then as the owner, you keep all the profits. On the downside, now you have all that unlimited liability if the business gets sued. You suffer all the losses. You're required to make all the decisions associated with the business. And if you die, the business dies as well, or the business is technically dissolved. You also have to raise all the money to start and keep that business operating. So if there's a cash flow issue, it's all on you.
What does it do for your taxes, street tax? You get tax breaks?
Well, you can, yeah. There are tax advantages too sometimes, yeah. Because if the business loses money, that can offset your individual income. But if you're drawing your only paycheck from that business, obviously it may not be good. Okay, partnerships. Partnerships are 2 or more owners. And if we're talking about just a pure partnership, not any of the newer organizational structures that are derivatives of partnerships and corporations, okay, there are more complex organizational structures than in these 3 basic structures that I'm talking about now. There's sort of a combination of the structures that have been created to attract business owners to the benefits of the different types of structures. So a partnership 2 or more, again, still unlimited liability to the partners. This is typically the smallest number of businesses in the United States. Again, easy to start, less regulations, flexible. You have more available money because now if, say, Evan and Jeffrey decided to form a business, they would have both of their pools of money to help that business get started and to grow. You would also maybe have the ideas and the management skills of the two of them. Let's say Jeffrey was the guy who could go out and find the customers, he's the marketing guy, and Evan was the finance guy, he's the money guy behind the scenes. They both bring their strengths to the table, okay? Whereas sometimes with a sole proprietorship, one guy gets going and he's got to be able to do everything, and you may not necessarily be good at everything. On the downside with a sole proprietorship, sometimes the managers might argue or disagree. Again, they still have that unlimited liability. They also have to share the profits, and if one owner dies, the business dies. Now, the other thing is too, now what happens if there's a loss in this business and the business has to pay some sort of, they get sued or whatever, and Jeff, they get sued for $1 million and Jeff doesn't have $1 million to help pay for it.
His house.
You declare bankruptcy.
Okay, that's great for Jeff. Now what about Evan?
Declare bankruptcy.
Just because you declare bankruptcy does not mean you're going to get approved for bankruptcy. Okay, you can't just declare bankruptcy.
That was perfect.
That was perfect.
Okay,
Yeah,
so what happens? So Jeff can't pay that $1 million.
Evan pays it.
Evan pays all of it.
And then
So
pays
logically
it
speaking,
back.
you would think 500,000, 500,000, right? Well, no. If you have a pure partnership, there is no limit on their individual liability. So if Jeff's a schlep and he can't pay his bills, okay? If he can't pay his bills, then Evan's stuck holding the bill, the whole bill. Okay? Same. If Evan was a schlep and Jeff had all the money, he was a good saver.
Well, that's
and
why he's invested in Subway.
okay? Then Jeff would be stuck holding the whole bill. So that's a big downside of partnerships. Okay, corporations. So the corporation kind of has some, big benefits. So you can have a lot of people own a corporation. The liability is limited, okay, in corporations. They are managed by a board of directors, and they're the largest volume of dollars in terms of sales. The challenges or the benefits is the limited liability, more money for investment. They are a separate legal entity from the owners, and if something happens to one of the business owners, the business operations are not interrupted. So that's good. On the downside, there's high startup costs because, as we'll learn, to start up a corporation, there's a lot of money involved. Okay, you have a lot of money that you have to deal with, and you also have a lot of legal stuff that you have to deal with in order to incorporate. And it can also be very time consuming. So, in order to set up a corporation, they have to file a separate application. That application is called the Articles of Incorporation.
How come a lot of companies go through Delaware?
Very good question. A lot of companies go through Delaware because the nature of the taxes in Delaware is very attractive to corporations. So a lot of corporations incorporate there. That's why I'm going to move there when I retire.
Really?
Yeah. That's where I'm going.
Bethany Beach.
It's very nice. Yeah.
What's that noise? Miss Bugatti, I have a video
Okay,
to
can you
show.
turn that down, please?
But he's declaring bankruptcy.
Say what?
I have a video to show. Can you go and Google Classroom? It's only 1 minute 27 seconds.
That's what I was asking.
Can I
That's
finish my notes?
Oh, okay,
It's
yeah.
not.
All right. So you have to get approved for the corporate charter. And it outlines the articles, what we call the Articles of Incorporation.